Hey everyone, and welcome. Thank you for joining us for today's Meet the Analyst webinar, D2C Brands, How Digital Natives and Established Brands Can Grow Amid Disruption. I'm your host, Blake Drosch, eMarketer Senior Analyst at Insider Intelligence in New York City, and I'm joined by my colleague, Andrew Lipsman, Principal Analyst in Chicago. Hey Andrew, it's great to have you here today.
Hey Blake, great to be with you.
Before we get into the main presentation, I'd like to thank Podium for making today's webinar possible. We'll be hearing later on from Hally Pinaud, Vice President of Product Marketing at Podium. She's joining us from Atlanta. Hey, Hally.
Hey, Blake. Thanks for having me today.
Thanks for being with us. A few things before we dive in. We have a ton of information to share, but there's no need to take notes. We'll email you a link to view the slides and the full recording, but we definitely do want you to participate. So just use the chat window on the right to submit questions at any time during the presentation. We'll get to as many as we can during the Q&A. So with that, let's get started. Andrew, what's on the agenda today?
Thanks, Blake. So before we begin, I do want to briefly begin by acknowledging the tragic school shooting in Robb, Texas, in which more than 20 lives were lost. I know our thoughts today are with the families and communities affected by the senseless tragedy. With a bit of a heavy heart, I'll begin and take you through our agenda. So what I'm going to do today is begin by kind of laying out a conceptual framework for how to think about D2C and the rise of the D2C movement. That's in the first section where we talk about D2C going over the top to disrupt. Then we'll get into some more data-driven slides about the state of D2C e-commerce today, including our latest forecast data. And then also about how D2C brands can grow amid current disruption. And then we'll conclude in talking about some key takeaways about how you really build a breakthrough and enduring brand in the digital age. So let's talk about going over the top to disrupt. The framework that I mentioned is what I have called the new media value chain. And I'm going to take just a minute or two to unpack this because I think it kind of lays the groundwork for everything that we're going to discuss from here. So the new media value chain is the evolution from the old media value chain, and I'll walk you through both of what those are. The media value chain, if you think about it, really illustrates how brands reach consumers from content through commerce, right? This is how we experience brands and then ultimately transact on those brands. Now, in the old model, think of this through the lens of the era of print and traditional TV. The value chain was really characterized by constrained supply, both in content and in physical shelf space. Content at the time was static and it was bundled, whether that was in a newspaper or the cable bundle. Distribution of that content was very capital intensive. You had printing presses and laying cable. The audiences that were reached with this media were really mass media segments. Think broad demographics, 25 to 54-year-old females, for example. And then commerce, where those brands were transacted upon, was in-store with the physical shelf constraints. Fast forward to today, the new model, which is fundamentally characterized by the digital era, where we have infinite supply, an endless scroll of content, and an endless aisle in commerce. Content is dynamic, it's atomized. The distribution is digital, so it's very asset light. The media formats that we typically experience brands through are social media or streaming video. The audiences, and this is really a key one, are niche, right? They can be highly, highly targeted based on not just demos, but interests, and other targetable aspects, and often through algorithms. And then lastly, commerce isn't just transacted through physical stores. It's also e-commerce. So in the old model, you had this kind of long path to purchase. And in the new digital model, you can theoretically have a very short path to purchase, where a consumer can experience a brand instantly through a social media feed and then transact on it instantly. So that middle part of the value chain, which has traditionally been kind of run by these important intermediaries, can collapse. And so for brands to be able to kind of go over the top of those middle parts of the value chain is why I call D2C an over-the-top strategy. One final point that I'll also mention here is that audiences, because audiences can be so fragmented in the digital age, this also helps explain the rise of influencers. Here's Kylie of Kylie Cosmetics as an example. But really, they've done the hard work and the heavy lifting of being able to aggregate these audiences and break through the noise and all the content to get people's attention. So that's really what's scarce and in short supply. That's why influencers are a really critical part of this equation. So with that all said, what does it look like when brands go over the top? So I'm going to take you through an example of a digital native brand and then also an established brand. In this presentation, we're going to be exploring both aspects of digital natives and established brands employing D2C strategies. So I think of the kind of original D2C brand as Dollar Shave Club. They had this viral video that they produced for $4,500 back in around 2011 or 2012. That really captured the zeitgeist. It was very irreverent. It was funny. It went after, Big Razor, aka Gillette, and promised cheaper blades that people could get more easily. And that was a way that they went over the top of traditional mechanisms and intermediaries to disrupt. With established brands, we have a current example of Tesla, which actually went over the top of the traditional intermediaries of the auto industry, car dealerships, and started selling direct to consumer through showrooms and then pushing those transactions online. And by the way, they also have done this all without advertising, without mass advertising, in large part because of a very famous cult of personality and over-the-top persona in Elon Musk, who has kind of used that cult of personality to successfully use an over-the-top strategy to disrupt. Now, the barriers of entry in D2C world got so low through that new strategy that I mentioned that brands flooded into the space by the dozens and then by the hundreds. And what you started to see was just a sea of new brands. And what ended up happening as they flooded in is the space got more competitive. And a lot of them started to look the same and act the same. They followed a kind of formulaic approach to D2C world. So what was once modern and interesting and innovative, I think quickly became kind of boring in some sense, for many brands at least. I love this article from Bloomberg a couple of years ago that said, "Welcome to your bland new world." It was really the rise of the D2C brands, right? So standing out, just like it is for any brand, can be hard when there's a lot of competition. That's not to say that there aren't some really great, strong breakthrough brands from the D2C movement. Not every one of them, by the way, is a breakout success story in terms of financial success. I think the path to that can be a challenge, but when I show you this slide, I think you can see a lot of brands. You can see, if you squint hard enough, you can see the brand name in many cases, but I'd say most of them are probably pretty identifiable on site just based on their products, their color schemes, et cetera, alone. So that's kind of achieving the first part, which is being distinctive as a brand. So every breakthrough D2C brand ultimately should aspire to achieve enduring brand status, and that's not easy. So if we think about the brands that I showed, all of them really succeeded with Act 1, the first act, which is just garnering attention through differentiation, a brand that solves some sort of customer pain point. And here I look at some brands like Dollar Shave Club, Outdoor Voices, Casper, that really did this incredibly successfully in the earlier days. But that's not enough. The brand needs to grow and they need to have a second act. And I think many have struggled to have that second act, which I call land and expand, where you really establish that brand, some credibility, some awareness, and you start to expand into new channels, new product lines. But this is kind of the messy middle of becoming an enduring brand. And I think a lot of them have to learn lessons the hard way and kind of trudge through to get to Act 3, which is enduring brand status. Here is a selection of brands coming from the D2C movement that I would say, to me, have achieved enduring brand status. Doesn't mean all of these brands are super profitable. They're not. Many of them have struggled. But I think there's a path to profitability in large part because they have really strong, enduring, category-defining brands that stand for something that fundamentally taps into the needs of the modern consumer. So these are the ones that when all the dust settles, I think we're going to see them live on in some capacity, and others will find their way to this point as well. At the same time that we see these digital natives trying to grow and become an established brand, an enduring brand, we have established brands like Nike and others going D2C. Now, why are they doing that? In large part because there's profits in it. Many of these brands entered into the mainstream through retailer partnerships. That's how they grew the brand to scale. But if the brand is strong enough, you see this illustration of a Nike shoe where there's a huge portion of it that goes to the retailer margin. If you are Nike or other brands in a similar position, you look at that margin and you say, if I can sell through my owned and operated channels, which in the digital age is a .com site, or in some cases it's stores, but those obviously entail a bit more work and capital expenditure. If they can pull some of those sales into their owned and operated channels, there's potential to drive real strong improvements to the bottom line. I thought this whole trend between what D2C digital natives and established brands are doing was well encompassed by Webb Smith, the founder of the 2 p.m. newsletter, who said, the brands with sales and stature to own their distribution can and will move towards an owned store D2C model. Brands working to reach profitability and scale are moving towards third-party retail wholesale partnerships. So now I'll quote myself here from my D2C Brands report. I will say, as I look at what's the common theme or thread between both established brands and digitally native brands, it's that ultimately their objective shouldn't be about building a D2C brand, but rather about building a brand that can go D2C, right? That D2C component is really secondary to the brand. That brand that means something to the consumer that they're willing to pay a premium for is ultimately where financial success comes from. Okay, so let's talk a bit more data here. I'm going to take you through the state of D2C e-commerce today. So this is our latest forecast that goes through 2024. And I'll point you first to 2021. Last year, we hit a point with $128 billion in sales. That was a 25% growth rate over the prior year. And you can actually see that each of the 4 or 3 preceding years to that saw growth rates in excess of 25%. So just really fast, consistent growth in this space. By 2021, D2C e-commerce accounted for about 1 out of every $7 transacted online. Over the next several years, we expect the market to nearly, not quite double by 2024 to over $200 billion. And it will continue to gain share of the total e-commerce. Growth rates will moderate a little bit this year. It will decline to 21% and the high teens in the next few years, but that's going to still exceed overall e-commerce growth by several percentage points every year. Now, who encompasses the D2C market? In terms of the number of merchants, it's really predominantly small brands. In fact, 3/4 of them are those that are making about $5 million or less in annual sales. Most of the rest are those making between $5 and $50 million in sale, and only a very select few, about 1.5%, ever hit that $100 million threshold. Now, that said, those that do hit the big threshold end up driving a huge percentage of D2C sales. So we're looking at that same trend forecast that I showed you 2 slides ago, but we're breaking it down now between established brands and digital natives. And what you'll see is those established brands in red make up the vast majority of sales in the market. I think this surprises a lot of people when they think about that. This year, it'll be over $100 billion just in established brand sales and another $38 billion in digital natives. But 75% is coming from those existing large brands. And it's not just the scale of sales that they're driving through D2C channels. It's also that their growth has surpassed the digital natives. Here, if we look back to 2018 to 2020, you can see that the digital natives were growing really fast in the 40 to 60% range in those years. It was venture-fueled growth, and they were growing really fast. The pandemic came along. At the same time, established brands were starting to get their legs underneath them, and those growth rates started to creep up quite a bit into the 30% range. And they've been able to parlay that into continued success with growth rates well into the 20s, at the same time that funding has pulled back for digital natives, and those growth rates have started to really taper into the teens. So if we look at some digital natives web traffic, which obviously is an important determinant of sales and conversions, we can also see what's happening here over the past 3 years. I picked 5 of the most well-known brands: Dollar Shave Club, Casper, Peloton, Warby Parker, and Allbirds. And if you just look at 2019, you can see that a lot of those brands already were starting to see traffic slide a little bit or falter, maybe with the exception of Peloton there. By 2020, we get the pandemic bump, and all of them really got a boost in traffic. Peloton got a huge boost in traffic that you see there, a big spike. But then as we made our way into 2021, those growth rates started to taper off in a lot of cases. And I think, got back to a continuation of the trends that we were seeing pre-pandemic. This one's a bit of an eye chart, but I'll just kind of highlight the key things. We're looking at the top 25 D2C brands in terms of traffic, according to SimilarWeb, for 2020 and 2021, and their year-over-year percent change. And what you see, first off, Chewy is the most trafficked of all the D2C brands, still seeing healthy growth last year at about 20%. The other ones I've highlighted are the small handful of brands in the top 25 that are still seeing really strong growth in traffic, at least 50% year over year. OpenSea, Skims, Hims, and Ruggable. Outside of that, though, there's a lot of brands that are seeing really modest growth, or in many cases, declines. In fact, 9 out of the top 25 D2C brands are seeing declines. Part of this happens when you can't keep spending to acquire traffic as much as you could a couple of years ago. At the same time, established brands continue to do better. I mentioned Nike. Nike has really been at this D2C strategy. They call it consumer direct for the last decade or so. And you can see the share of their revenues that are coming from direct sales. It's crept up a few percentage points every year to last year, where it was about 37% of sales. And again, part of their strategy has been about cutting off key distribution partners. Most recently, they cut off Foot Locker, and a lot of other large retailers are no longer getting Nike's best product. But there's other brands like Lululemon, Adidas, Crocs, Levi's, a few others that are seeing similar percentages of sales coming through direct channels. And some of them actually are around 50% even. So this is certainly helping and bolstering their bottom lines.
Andrew, if I could chime in for a second, it's always really interesting when we talk to Nike. I mean, they're such a great example of many ways, but sometimes I think we tend to view them as the exception, right? That Nike, because of the fact that the brand is so strong, has leverage when it comes to where they want to distribute their products and how they can reach the consumer directly. What does it really take for these other brands these other legacy brands that are seeing success in going to D2C that aren't sort of that golden exception of a really strong brand like Nike?
Right. I would say the lessons still apply. Not every brand is as strong and has the magnetism that Nike does to pull sales as easily. So there's a dance, right? They are often very dependent on wholesale partnerships. They may not be able to be as aggressive as Nike in pulling those sales into their own channels, but they can do it in a more modest fashion and sort of stack rank those distribution partners. But at the end of the day, it does come down to having a brand that consumers want, having really strong brand equity, and making sure that you have the channels to keep that brand awareness really high and the desire really high. To bring consumers into those owned and operated channels. So we've talked about what it takes to kind of grow for brands today, but it's set amidst a backdrop of a ton of disruption in the landscape. I think foremost among anything, and most conversations, frankly, start in e-commerce today with the supply chain. I'm not going to belabor that point too much. We know that that's increasing costs through every part of input costs and everything that goes along with that. But one of the other key areas that is increasing prices for D2C brands is digital advertising. So we have seen since the pandemic prices that, is really how most D2C brands acquire customers, go up quite a bit. Social ads have always been kind of the lifeblood of D2C brands, particularly Facebook and Instagram. In the past year, this data, according to Sky, we saw prices go up 22% in social. That's not insignificant. Similar story with search. A lot of them, are very dependent on search as well. That was up 23%. Interestingly enough, I've got retail media in here. That's the one that didn't increase quite as considerably. Most D2C brands have kind of avoided selling through retail media channels. So the channels that are most important to them are increasing the most. And it's not just about the overall price increase, but they've also been very data-driven advertisers and highly dependent on the ability to target audiences effectively and measure the impact on conversion. And Apple introduced privacy changes in iOS last year that has really disrupted this space. And this has kind of upended D2C brands' budgets and how they're spending. So this data from Rockerbox shows share of D2C brand budgets over the past 5 quarters, essentially, from that pre-iOS change period to more currently. And it's broken down between Google spend, Facebook spend, offline, which is direct mail and TV, and then other digital. And what you see here is obviously a sharp decrease in Facebook spend from about 35% of budgets to 27%. Google has benefited a bit, but as have the other channels as well. I think where this data gets really interesting is when you break it down into the specifics of small, medium, and large D2C brands, because the story is a little bit different. Now, Facebook, you can see here with small brands, that Facebook share was higher and declined about 12 points from 58 to 46% of spend. Large brands, a similarly dramatic drop from about 33% to 24%. Medium brands actually didn't shift all that much. So where did those budgets go? For small brands, Google. You see, as much as they lost in Facebook spend, it went right into Google, almost 1 for 1. And in large part, that's because these brands are highly dependent on those channels. Facebook and Google is what they're most accustomed to. So if they take it out of one, the path of least resistance is to just push those dollars straight into Google. For large brands, they've tested into a lot more channels. And so, and they're already heavy spenders on Google. So you see that Google is pretty consistent, but they've been able to ramp up their spend in those channels that they have tested offline, which is TV, direct mail, and other forms of digital. So I think that's just really interesting to see some of these disparate dynamics depending on the size of the brand. Other brands, D2C brands that have started to progress are starting to move into some of these channels, more traditional channels like TV. This data from iSpot shows in last year, first half of last year, what are the most seen D2C brands on TV. And it's pretty interesting to see this list. Peloton far and away was #1 and growing pretty significantly. And they use that to, develop their aspirational brand ethos and drive awareness. Most of these brands basically have a couple of things in common. They're either very high ticket, because TV spend is more expensive. Think mattress brands, or they're high lifetime value, right? These are recurring revenue model subscription businesses. Maybe it's not a surprise then that you see that top of this list by a long shot is Peloton, because it's both, right? There's really expensive $2,000, $3,000 equipment. At the same time, there's that recurring revenue model of their media subscription. It's not just about going into TV in terms of traditional, but it's also about going into physical retail and stores. This research from Diffusion shows some of the leading reasons that adults actually would buy traditional brands over direct-to-consumer brands, and a few of them really just come down to physical availability, right? I mean, 80% of retail sales still happen in stores. So being on the shelf when people are ready to buy is still vitally important. And this is why you've seen a lot of D2C brands, once they hit a certain threshold, they realize our path to growth really has to go through brick and mortar, whether that's opening our own stores or through wholesale partnerships with existing retailers, or a combination of the two. Okay, so we'll wrap up here in this final section talking about what it takes to really build a breakthrough brand in the digital age. So I think established brands and digital natives can learn from each other. there's some great lessons to be applied across the board as we kind of get convergence between these different types of brands. So established brands, what can they learn from digital natives? I think the first one is just about addressing unmet customer needs. A lot of the established brands got disrupted, frankly, because they lost touch with the modern consumer in some ways, and they weren't meeting all of their needs. Digital natives did a great job of understanding what consumers wanted. They did that through a combination of first-party data to get closer to the customer, but also just good old-fashioned intuition, right? They just realized what consumers needed to meet their modern lifestyle, and they provided that, and that allowed them to get a foothold in the market. The second was that they treat customer experience not as a cost center, but as a loyalty driver, right? It might be more expensive to provide more high-touch customer service, really thinking about the boxing or packaging experience and unboxing and everything in terms of how a consumer experiences that brand, the quality of the website. All that stuff matters to the consumer, and that's what drives loyalty. And as I mentioned, that lifetime value, which is a critical part of the equation. They are testers and learners, right? We always hear this test and learn thing, that it's about fast iteration on product development. You can't try and develop a product that you release, 2 years from now. The consumer is changing very quickly. So you've got to get it out to market faster. D2C brands have done this sometimes in a matter of months to get a new product to market. They find their consumer through fast iteration on ad optimization. And then they keep doing that and build cumulative gains and advantages very quickly. And then lastly, they understand the role of the influencer. As I mentioned in digital, they serve a really critical function. They've kind of become a new media channel in their own right. And these brands have really leveraged influencers of all varieties to get traction on these digital media channels. So when I think about kind of the big takeaway is that digital natives really are exceptional at just cutting through the noise of digital. They understand what it takes. They understand how to breathe life into their brand, often through key personalities, in some cases celebrities, to cut through the noise. From the standpoint of digital natives learning from established brands, it's about learning how to cultivate brand distinctiveness and differentiation in the market, right? You can't just blend into a sea of the same and be just another brand. You have to really think about what your brand stands for, what that point of view is, and how your brand is distinctive visually for the consumer so they can identify it quickly and have some affinity for it. Amplifying that distinctiveness really depends on brand building advertising, right? So TV shouldn't go out of style. Brand building is still really important. And I think that even though it's more expensive, it can't just all be about cost-effective advertising. You have to be willing to lean into some of the more expensive forms of advertising that do build brands. And then lastly, it's about leveraging physical retail in whatever form to put the product within reach of the consumer and gain that distribution if you want your brand to have that level of ubiquity that it needs to be a durable brand. So at the end of the day, established brands, the key lesson is they're not created overnight. I mean, getting back to Nike, I think about Nike all the time. My first experience with Nike when I was probably 6 or 7 years old, I remember buying I think it was just plain white sneakers with a red swoosh. It came in this orange box. And that's always stuck with me. I've always loved that orange box, and it resonates with me. I also grew up in the 1980s in Chicago, big Michael Jordan fan. You have these Air Jordans and this distinctive aspects of Just Do It and the Michael Jordan logo. It's all so distinctive. It's all part of the brand heritage, and it's allowed them to evolve into the future with celebrities or celebrity athletes like Serena Williams and Tiger Woods to continue to extend that brand into new facets of greatness. So finally, what do I think are the hallmarks of truly breakthrough, durable, enduring brands in the digital age? These are kind of the keys that I think that most brands will hang their hat on. The first one is an understanding that advertising should leverage a combination of both branding and performance. And I really focus on connected TV as a huge avenue for that growth. Hulu is where maybe the most inventory exists today, but there's a lot more connected TV inventory that's opening up where brands can both target the right audiences and scale up into bigger and bigger audiences to grow awareness and performance over time. Second, they will leverage authentic brand ambassadors. It may be celebrities, it may be other personalities who are integrated into the brand experience. Think Peloton instructors who really help communicate the brand with a human touch. Loyalty is very important. They will use digital channels to drive that loyalty. So Peloton, I just mentioned, part of that loyalty equation is that consumers or Peloton riders are engaging with the brand sometimes on a daily basis through that digital experience. You also have Glossier, which has a blog into the gloss that's heavily integrated into the brand, actually inspired the brand in the first place. This is a way that you connect with that consumer, even if they're not buying your product every day, how you stay relevant and connect with them on an ongoing basis. And then lastly, I think brands really need to understand that you can't overextend yourselves and go into too many areas too quickly. You have to master your category before you expand your brand. One of my favorite recent examples is Lululemon going into footwear. Huge category. I mean, just tons of potential in it for them. Their ability, and it's met with some really early success. I've only heard really strong reviews from Lululemon's footwear. Their ability to do this and grow into just a massive opportunity for the brand has everything to do with the fact that they mastered athleisure first, didn't jump into it too early, but now they go into this category with a ton of credibility. And it's just a really natural extension of the brand. And I think the dollars and financial success will flow from there. So that is it for me and my presentation. I'm going to kick it back to you, Blake.
That was really great. Thanks so much, Andrew. Before we get to your questions live now, we're joined here with Hally Pinaud, Vice President of Product Marketing at Podium. Welcome, Hally. Thanks again for being here.
Yeah, it's a pleasure to be here, Blake, Andrew.
So we've got a couple of questions for you today. The first question that's sort of pressing is all about physical locations, right? So physical presences for D2Cs have been a real advantage for a lot of these businesses. How can D2Cs make the most of a physical presence?
Yeah, that's very true. And here at Podium, we spend a lot of time with local businesses who are all about that physical presence, right? And I love the stat that Andrew shared earlier, that consumers are very swayed by physical presence, right? It's convenience. And local business is still an enormous part of how consumers shop. And D2C brands often fit really comfortably into the physical shopping experience in 2020. I'm thinking about some of my favorite places to go and shop and the fact that a Peloton store is right there and it's naturally just part of the experience. And it's really often, particularly when they have their own locations like that. So what's interesting for D2C brands is they're making that move into the physical space. And when they're looking to go local, they can really take a page, not from the big box stores, which I think are almost the antithesis of the kind of experience that they've really kind of worked to build with their customers, but rather from true local businesses whose brands are smaller, but usually built on expertise and experience, very similar to what a D2C brand is trying to do, rather than that sort of ubiquity or we sell it all that the big box stores are more known for. And in that world, reputation really matters, reputation management, but it's slightly different. Factors like local reviews, for instance, can really matter when you're trying to build a physical presence. Coming up in the near me searches are another flavor of Google dominance, given that D2C brands care so much about Google dominance already. It's a flavor of Google dominance that they want to consider when they start to introduce this strategy. And, Google reviews and that sort of near me presence, because, when you go to type into Google, sunglasses near me, you want Warby Parker to come up, right? It's really a part of that strategy. It also matters to think about that online offline experience, because it is that additional component. So many of these brands have really built excellent, world-changing online experiences. But is it equally seamless if someone comes into your store, and do you know who they are? Is that easy for the people in your store to pull forward? How are you using that information to personalize? It's imperative that you start to think about how you connect those experiences so the consistency is there. And along those lines, your website can be a really important point in connecting folks to the experience online and offline, or if you're trying to sort of have that hybrid with whatever it is that the consumer wants. So when you have the latitude to think about locations, online often becomes one location, but it may not be what the consumer necessarily wants to be connected to. You need to make it easier to start conversations that can be triaged to local sales teams or local representatives, if that's easier or better for the customer. And there's certainly tools that can put that into place, but just some things to consider that, again, mom and pop and successful local businesses have been doing for years, because they are, again, kind of leveraging that same level of expertise and experience that D2C brands are also looking to build.
I love that comparison. And I think it's something that might not be super obvious when people talk about D2Cs, but that customer service element of the mom and pop store, and also the strength in customer service that D2C brands have. It's a really strong correlation. And then, so as we move on, you started talking about the in-store and digital. So we'll lead into a digital question next. Some of the challenges that D2C disruptors are facing are the social and the ad performance issues occurring through or due to Apple's privacy changes. So what other channels are heating up for D2C that you're seeing right now, Hally?
I really love this question. I'm getting this one a lot these days too, for exactly the reasons that you pointed out, and a number of other ones that Andrew pointed out in his presentation just a moment ago. Digital ads are highly volatile right now for a lot of businesses, and that's causing a lot of brands to explore new channels. In my opinion, this is a really important moment for brands of all types, D2C included, to really think about how they're maximizing conversions with the customers that they're already engaged with, particularly customers who are already on their lists, right? So thinking about that first party data and how you can really supercharge how you're using that first party data. What we're seeing, and this may not surprise some folks who are listening in today, but what we're seeing is that text marketing is one of the highest conversion, highest engagement channels out there. We're talking about a 98% open rate, which is about 4.5 times better than email on average. And look, I cut my teeth as an email marketer. I would have killed for a 98% open rate back in the day. So that's a really extraordinary engagement rate, as well as much higher click-through rates. And D2C brands have really been on the vanguard of experimenting with text as one of their channels in their mix. But for those just getting started, it's really imperative to think about this by following your opt-in regulations. Here in the United States, it's TCPA. You want to make sure that you have the tools in place to be compliant with that, because there are a number of fines that can be associated with not doing this right or doing it well. But, the reward is very much there for figuring out the strategy. And because I work so much in this space, I'll just share some of what we've seen in the trends with our customers, particularly in the retail industry. Getting personal on text is really critical to optimizing that conversion rate, and personalizing on a single factor. So we're talking about like past purchase, or location is actually a really big one, going back to our last question, where someone is physically, lifts click-through engagement by 2x or more. And it makes people much more likely to engage in that text thread. Similarly, identifying yourself personally. And what I mean by that is using a person's name to say, hey, this is Hally, I'm texting you from this company, makes consumers 50% more likely to reply as well, which is something that often surprises people when I share that, because they think about text marketing in the way that they think about things like email marketing, which are far more impersonal by default. Along the lines of also thinking about having a physical presence. This is actually one of those interesting places where physical presence works, not just segmenting on location, but also thinking about using text marketing as a way to garner more replies, because a good text platform can allow you to turn a thread into a conversation that can actually be triaged and fulfilled locally. And representative locally or centrally, depending on preferences, can actually kind of lend that personalization a little bit more, because consumers engage with text very differently than they engage with email. They're much more likely to reply to you, which is a great thing. It's great to have that engagement. But once they start replying, they expect a reply from you. And so creating that thread is something that, for instance, if somebody has experience working with your, central Dallas location, may be better to triage to that site or that physical location as opposed to handling centrally, for instance, if the expectation is that you've already built the relationship there. So just some things to keep in mind, but also some ways to really lean into personalization in a way that I think is somewhat unique for D2C brands.
Great, thanks. And then we'll wrap it up by just talking about websites. Do you have any tips on how to get the most out of the website?
Yeah, I won't pretend to be a UX expert here, but briefly, I can say the number one thing that we hear from consumers when we do research on what they would like to see from the retailers' websites that they interact with is make it easy to reach the business. Make it easy to talk to a human. Now, a lot of businesses with great web presences, D2C especially, have turned to chatbots or chat systems to do this with some success. I would really encourage brands as they're thinking about, again, how to optimize conversions of the folks that are hitting their page to think about that chat experience. The reality is a lot of consumers indicate that they're really turned off by bots. They know when they're talking to a bot, they prefer live, even when it's template assisted. There are ways to make your folks more efficient when they're using chat. And it's a bonus if you have locations, the ability to sort of route to preferred locations to assist, as I was mentioning a second ago. But we also know that consumers are 4 times more likely to complete the thread and transact if they've started a chat that turns into a text. So actually using that sort of chat experience to immediately push that to text messaging, right? So that people can take it on the go with them on the phone rather than lingering on their computer, waiting for your response, because we all know that sometimes you're not going to be able to respond in 30 seconds. Essentially transferring that to a textable number and having that be a part of your initial experience with a consumer on the website is a really great way to turn your website into a better conversion machine for your business. And one last thing on that, which is your website is also an incredible way to build your signups for re-engagement with marketable lists and text marketing. So connecting to that last question for a second here, you should be experimenting with the right real estate to drive offers and create and collect those compliant opt-ins. We see consumers of ours driving thousands of opt-ins, or rather customers of ours driving thousands of opt-ins in a month or two, just by having marketing text opt-in as a step in their web chat flow. So if you think about that as just one simple thing that you build into that flow, hey, we started a conversation, you have questions about my mattress that I'm selling. By the way, would you like to hear from us going forward via text? Thousands of opt-ins just driving that way. And that's one of those like sort of not so obvious places to start to build that marketable list and get more out of the folks that you're driving to your site and enhance conversion.
Great. Well, thanks so much, Hally. Those are really interesting stats with text marketing. Not entirely surprising how effective it can be when, especially with that personalization factor. We're going to move on now to the Q&A. We've gotten a lot of really great questions right from the beginning of Andrew's presentation. And I think as we think about certainly moving into the summer months, folks maybe getting a little bit, more gung-ho on going back to stores, and also some of the great points that both of you raised about, having a physical presence. Let's start off with just which D2C brands are we seeing right now that are really doing the best job in leveraging physical retail?
Yeah, I mean, I guess I would say, I think a lot of them, frankly, have an advantage because they're newer retail experiences and they're better designed for the modern shopping experience. So they don't overindulge in inventory. They don't have a huge store format. They're omni-channel by design. So a lot of times you can go in and use them as a showroom concept. Some of the ones that immediately come to mind would be like a Bonobos. And I think they just also have a nice aesthetic experience. So they're, in many senses, this isn't anything that's not necessarily D2C. It's just about creating a more modern, tailored shopping experience. But I think the consumer gets a good feeling about that shopping experience when they're in it. I will say a couple of other concepts that are interesting because it's letting D2C brands kind of go into physical retail in some innovative ways would be Neighborhood Goods, which has a bunch of different D2C brands, kind of like almost like a little mini mall of the future. And then there's a company Leap that actually helps, brands basically roll out their store footprints almost out of the box in an efficient way. So there's a lot of cool innovation that's happening there. But broadly, I think the whole space, in many respects, just because they're approaching it the right way from the outset, are doing a nice job.
And while we're on this topic, we had another related question, which I thought was really interesting. So how much of established brands D2C growth is due to pandemic changing consumer buying habits? And how much of this could be, quote unquote, undone as consumer habits revert back to in-store for those brands? Does that give digitally natives brands an advantage in the long term?
Yeah, well, so if I could go back to that slide where I showed the growth rates for each of them, we are forecasting that the established brands will continue to grow faster into the future. So all of them got a pandemic bump, no doubt about it. The growth rates really shot up in 2020 and stayed fairly elevated throughout 2021. But established brands have pulled ahead in part because they already have that established brand, right? The brand is durable and they can lean into that. They also have, in many cases, bigger marketing spend to deploy at the same time that these digital natives are seeing their marketing spend evaporate. So they're getting squeezed out of the market. So I just think there's a current scale advantage that the established brands have at this moment of time, at the same time that they're getting better at kind of running the D2C playbook.
And then last one on this topic, just because I thought it was another great question. And this is relevant to what we were talking about Nike earlier, but is there a specific point in the life of a D2C brand when it's best for entering retail?
Yeah, I would say no magic number. It's going to be category dependent, but with the caveats aside, I think you often hear about brands hitting a wall, even really the best brands hitting a wall in that $20 to $50 million revenue range. I think that's the point at which physical retail really becomes a necessity if you expect to grow anything beyond incrementally. And I know a lot of these brands go with aspirations of growing pretty strongly. But in Warby Parker, look at them as a great example. This is a great brand. They're doing things the right way. Their revenues are still less than $500 million and growing at healthy but fairly modest growth rates. And they have one of the biggest, if not the biggest, D2C brand physical store footprint today. So it's not that easy. It's, brands to grow, I think, do take time. But when they feel themselves hitting that wall at, several tens of millions in revenue, they probably need to go into physical retail.
Great, thanks. And then we had a question about Apple's app tracking transparency changes and how they're hitting Facebook. Does that change the situation at all in terms of D2C media channels really being still infinite?
The way that I would look at it, so first off, social media, it's the infinite scroll, right? There's still kind of this infinite inventory. I don't think that's changed in any meaningful way. The opportunities, as the prices go up, right, for an individual brand, it's not as infinite. And they obviously, if they've been very dependent on that channel, have to think about, well, where else do we go? And many of these brands, as I also had shown, the smaller brands really haven't been able to test into some of these other channels. So I think there's a huge opportunity for low friction channels, ones that may have been overlooked to some extent for brands to start to shift some of their thinking and some of their spend into. I don't know if Hally wants to add to that, but text is one of the ones that's certainly foremost in my mind as an emerging channel.
Thanks. And then this one can be for Andrew or for Hally. Do you have any suggestions for businesses handling problems regarding supply chain issues? Something that keeps coming up everywhere basically these days.
Yeah, I mean, this is one we get a question about all the time. And ultimately, when you have supply chain issues, it's actually really, I'm not going to say great, but it's certainly a moment to reinforce the sort of brand experience that you're trying to deliver to your consumers, right? And so the advice that we often give here is when you're having supply chain issues, be proactive, be transparent, keep the sort of brand experience that you're trying to deliver top of mind. This is another area where we say think through the channels that your consumers are most likely to be engaging on. So, we probably beat the text drum quite a bit here, but it is actually a very effective way to reach consumers, to let them know about the status of things that they've ordered, or to let them know that something is back in stock. It's actually a very effective marketing tool in that latter category. So really just sort of thinking through, how do you sort of exceed consumer expectations in spite of the fact that there are supply chain issues? Because the reality is that consumers are seeing this with just about every retailer that they're dealing with.
Just to echo this point, I mean, consumers are getting a lot of bad surprises in the customer experience because of the supply chain, and a lot of this stuff is out of the control of the retailer or brand. But I would say they can take back some of that control and really do right by their consumers by setting those expectations, right? I don't think consumers necessarily expect everything to come to them in 1 day or 2 days, or that there's not going to be hiccups in the process. But what they do is certainty. They want to know that they're not going to be on vacation when that package they thought was going to be delivered on time isn't, right? They want to be able to take action and be able to move that package delivery to another time. They just want it to align with what works for them. And the more proactive you can be in the customer experience, the better they can feel like their needs are met.
And so as costs increase, another good question. As costs increase, won't D2C brands have to start cutting corners on things that made them popular in the first place? Examples include product quality, customer service, and low prices.
Yeah, I mean, I think that's the rationalization that's happening at this very moment is when there was a lot of venture backing, they could really lean into high cost efforts and they weren't being held as accountable to the bottom line. This is probably why a lot of established brands have looked at customer experience as a cost center. I don't think those two things need to be out of sync. I think that it's about being creative in ways to deliver on the customer experience, but also do it cost effectively, right? Maybe it's not realistic to do super high touch, personal white glove service and interactions, or do those things without an additional charge, whatever the case may be, to make the economics work. But I think there are other ways, lower friction ways, automated ways, software driven ways that can, if not provide us the same experience, provide most of the experience they were previously delivering at a fraction of the cost.
And I'll build on that point, Andrew, because I think it's a really, really good one. Automated ways, software-driven ways, lots and lots of different ways that technology can facilitate a great experience at a lower cost. But one thing that is certainly prevalent with venture-backed D2C brands, and you see this with stories like Glossier, where they've gone and they've tried to build a lot of their own technology, is that actually this is a great moment to step back, look at the technology landscape and ask yourself, are there vendors that do this? Could we integrate solutions that perhaps allow us to develop or deliver these things at the standard that we've set at a cost that's actually more in line with a traditional retailer? And the reality is that there's been so much innovation in this space. The same venture backing that was helping those brands along was also, fueling a lot of innovation on the technology side for D2C brands, among other kinds of retailers. So it's a great opportunity to just look and see, do I have to build this myself, or could I buy this and integrate? Just something to reflect on in this moment when you're looking at the cost of doing things and realizing that buying versus building is often much more cost effective to buy.
It's such a great point. And a lot of D2Cs felt the need to position themselves as technology companies. And I think almost everyone that tried to build something found out it was a lot harder than they thought. And they're a consumer brand, right? They shouldn't be trying to be a technology company. And there's so many other providers who have already done the hard work. So take what's already been done and leverage that in a much more cost-effective manner.
Let's segue that into a semi-related topic that relates to our next question. One of the big trends is, you have these D2C disruptor companies. They get really big, they threaten the old guard, and then the old guard comes in with an acquisition to degrees of varying success. One question that we got is, do you think Dollar Shave Club has been a good investment for Unilever? And I'll add on that and say, are there any sort of telltale through lines when it comes to, what might be a successful acquisition of a D2C company versus one that is basically just snatching up a threat to your competition, and then ultimately isn't built for long-term success within a larger brand?
Yeah, for Dollar Shave Club specifically, this actually came up on Unilever's last earnings call. They basically acknowledged, the CEO acknowledged that it hasn't met their growth expectations. Now, I don't think it necessarily has been a bad investment, right? Maybe there's some things to work out. I still think there's potential for it. One of the things that the brand did lose, though, was Michael Dubin, the CEO and founder of the original brand. He was central to that brand breaking through and the brand ethos, and some of that maybe has been lost. So it's not going to be easy necessarily to get the most out of that brand. I don't know if there's great through lines in terms of what makes for a really successful acquisition, right? It's sometimes just it's acquiring that competitor that has become a real ankle biter. But all of a sudden, just once you acquire that market share, you're acquiring a competitor that at the same time is kind of killing your margins. So you're now caught in this trap. So yeah, I mean, I think there can and will be successful acquisitions, but I don't know if I see a common theme yet to date in terms of what that would look like.
Great, interesting. And I think we've got time for one more question. And this one just came in, and it's about the role of sustainability in D2Cs. I mean, you've got startups like Allbirds that are really hyper focused on just having, sustainable product. Is the sustainability trend still prevalent in D2C? And is that enough to give a D2C that might have started within the last year or starting up now? Is sustainability still enough to give a D2C upstart traction?
In short, no. I mean, sustainability is a macro trend. Modern younger consumers particularly have been attracted to this, and there's some great brands. Rothy's is one that comes to mind for me, that have really had that central to their whole brand ethos. But so it seemed like every brand that flooded in, like when I think of the brands, I think about what's your sustainability take. So many of them have been like a B Corp status and all these sorts of things. I think these are great on balance, but I no longer see that in most cases as providing distinctiveness to the brand or as a differentiating factor.
Well, unfortunately, that's all the time that we have today, but thanks again to Andrew for joining us, and a very special thanks to Hally and the team at Podium. Our eMarketer production crew behind the scenes this whole time also deserves a huge thank you for making this webinar possible. And as promised, we'll be emailing you soon with a link to the slides and the full recording. Before we wrap up, let me take a moment to tell you about what's happening across of eMarketer's media channels. You can register for upcoming live analyst and tech talk webinars at eMarketer.com/webinars. On the audio side, don't forget to tune into Behind the Numbers, which is eMarketer's daily podcast at eMarketer.com/podcast. And finally, please check out our newsletters as well. Thank you again for joining us, and we hope you enjoy the rest of your week.